It really comes down to what people don't actually understand from an education perspective. And by the way, you can't learn it overnight. Everything takes time, TIME, things I must earn. And when you're subjected to either other people's opinions, accountants, other fiduciaries, other financial planners, what you see on TV, what you hear on the news, our brain is affected by everything. And it really comes down to the pain, pleasure principle, or fear and or greed, right? So we know that if things are painful, typically people want to avoid pain and run to pleasure. And by the way, it's everyone's opportunity to make money and be capitalistic. But when the markets are running, and whether it's Bitcoin, whether it's crypto, whether it's real estate, whether it's the S&P 500, whether it's individual stocks, and these things are taking off and they're doing it for years, what begins to happen psychologically, there comes to be an expectation. And I think the person that is not sober in their thinking and saying, okay, how do I deploy a certain amount of conservative dollars over here, even as these markets are running? And a lot of times somebody is telling them they should double down and or triple down, and they'll make even more money because there's no in the foreseeable future, we don't see the markets changing. So between August 2021 and the end of the year, there was a massive run of real estate. I mean, I was trying to buy a house, me and my wife, and they were going over 30% asking price in houses that were multi-million-dollar houses. And when I looked at Bitcoin and or some of those other type of coin investments, there was people that I know that were not in the financial planning space at all, that created call centers and or handoff centers to people that were educating other people on how to buy crypto and trading it and telling them how to buy and sell it. And there wasn't a license in sight. And once they tried to get their money out, it became like, hooks and ladders and Houdini acts and trap doors. It was like really super complicated, even when things were running to get the money back out. And remember, when you're trading something, whether you're flipping a house, whether you're trading stocks, trading the Bitcoin world, you're gonna go short-term capital gains, right? So there's a difference between long-term and short-term capital gains, and psychologically, it's almost like steroids, and there becomes this expectation of it's gonna keep happening. So now, when you get with the person that's conservative by nature, that person's information and or suggestions get drowned out when everything is running, because if somebody's cutting my hair like they used to back in March of 2000, and my internet stocks that I was, bringing to my clients were going from 4 to 40, but the guy cutting my hairs were going from 3 to 400, well, guess what? Everyone's gonna listen to the guy cutting the hair, right? So when we look at our kind of planning, it is about education. It also is about diversifying, and I say this all the time, diversifying within and amongst asset classes, right? Diversify within and amongst asset classes. And that means real estate, that means life insurance, that means your S&P accounts, that means your 401ks, your IRAs, your after-tax accounts, that means gold and silver, that means your businesses, all these different things, right? Now, what happens when the person starts to make it really, really fun and they start making a lot of money in these Bitcoins and or flipping real estate, not buying it, but flipping it, they begin to drown out anyone that's given reasonable information. And then when things start going south, and we go to December, right into December, there was no calamity belt, but we started hearing about a potential war in the Ukraine. We get to January, there's, the war's going on. Now all of a sudden, it's March, April, May, we're at 40-year highs on inflation. And they didn't even start to raise interest rates yet. So now all of a sudden, we go from inflation to a forced recession. And everybody should go back in time right now. Mark my words, go look what Paul Volcker did in 1980. He raised the rates so much that it really disrupted the system, and a lot of people got shook, and we haven't even seen the shakeout yet. At least that's what a lot of economists are saying. That's what my intuitiveness is saying. So at the end of the day, the person that's conservative in both up and downs, that has a philosophy and a strategy, I often say this, I was just on Chris's stage, my people are high stepping through this recession. Like, they're just like, all right, where's the next red dot special? What's on sale over there? Where can I deploy my money over there? Because when you run it through insurance and you build up your cash value, I'm not talking about a typical insurance agent out there that's gonna sell you a product where the cash value takes 3, 4, 5 years to build up. I'm talking about the kind of policy that is over and super funded that you could leverage. Now, just because you're leveraging it, don't find a place to put your money, just wait, right? Be very patient. So right now, if you look at real estate, the flippers are going away. The folks that run real estate at a high level are the ones that are like, okay, these lower houses between $200,000, $300,000, we're gonna be able to get them on discount. And by the way, if we got cash, we could really run it, because now we get to dictate what price we buy it at. We don't need the bank to say yes or no. And when you look at real estate, you look at overfunding your policy, and even when it comes to the world of the stock market, right? At the end of the day, here's some good bullets, and I don't think anyone's ever followed this to the T except for the best of the best of the best of the best. But if you look at the S&P from 1980 to December 31st, 2021, the average rate of return, assuming that the dividends were reinvested, was 12.4%. 12.4% over that 41-year period. However, the real stat is the average decline in the S&P during that same time frame in intra-year. So during the year was negative 14%, right? So that means psychologically behavior finance kicks in. All of a sudden the gal that was making a lot of money over here, now all of a sudden they owe money, all their other investments aren't working, panic sets in, they sell everything prematurely. Staying with this fact, at the end of the day, 35 out of 41 times the S&P ended up higher by the end of the year than it started. 35 out of 41, even though intra-year was down 14. Here's the other chart that you gotta think about. In the last 50 years, there was 5 times that consumer confidence was at all-time highs. Every time that happened, the S&P ran on average another 4%. But here's the magic. When consumer confidence during that same 5-year time stretch over 50 years was at its lowest point, like it just was about a month ago, the bounce back on the S&P over the next 12 months is about 24%, which by the way, even if the S&P goes up 24% from June, it's still gonna be off its all-time high. The point is, charts tell stories, right? Financial planners tell stories. And remember, if your financial planner does not talk to your accountant and just refers you to people, or does not talk to your estate attorney, or does not talk to your insurance agent, and as a matter of fact, if you have a fiduciary that doesn't include any insurance products as part of a fiduciary mindset, then they really shouldn't be a fiduciary, because at the end of the day, if I have a client, and if there's a fiduciary that has a client and they're not recommending long-term care, or they're not recommending a certain type of fixed annuity or some kind of an annuity plan in the overall mosaic, or if they're not recommending some kind of life insurance besides term insurance, which is the easier, softer way so they can manage more money. And if they're managing your money and it's a 401k and an IRA, knowing that 20, 30, or 40% of that eventually is gonna go to the government because of taxes, then maybe they shouldn't have their fee that's associated with the dollars that are gonna go towards taxes. I want you to think about that. You have $1 million. You have $2 million, you're 60 years old or 65 and you start taking distributions. That $2 million is still being charged a fee. How come that fee doesn't take out what's going to the government? I think that would be a logical thing, right? So the fiduciaries, whenever the market kind of corrects itself or goes into a bear market, which is happening right now, they typically say buy and hold, dollar cost average, rebalance, good information. But the real good fiduciaries are the ones that are connected to all the other planners and that are really receptive and open to understanding that, hey, there's some folks out there that make a lot of money buying real estate for the long term. That's not a fiduciary, they're not buying and selling real estate for the client. Here's what it comes down to. How do you get educated? Well, the first thing you need to do is you need to make sure that you understand what your investment philosophy actually is. What is it that you want? What kind of risk are you willing to take? Where do you want to be 5, 10, and 20 years from now, right? That's like where it starts. Then it's like, okay, do you have an accountant? Do you have an estate attorney? Do you have a fiduciary? Do you have an insurance agent? And do they communicate? If they don't, go ahead and click that link below. We'd love to be able to set that up for you, right? And be able to show you what that looks like. There's no obligation on your part, but at the end of the day, if you want to really learn how to bring all the pieces in place, we can show you how to do that. And do you have a place where all your assets are on one landing page that are organized, structured, and you can, in fact, be able to put yourself in a position where you have financial organization at the highest level? Because a lot of folks, they buy a lot of products from a bunch of different people based on a bunch of different opinions. They then have a junk drawer of financial planning, and they really don't know how these products communicate with each other. Anyway, thanks for checking us out. Please like, follow, and share at all times. No obligation. We're here to serve, contribute, add value, answer any questions. If you have any videos you want us to do, please let us know. And oh, by the way, continue to hit that subscribe button. We're going to be dropping information on a daily basis.